Welcome to This Week in Venture Capital. My guest today is Scott Painter. Very excited to have you on today, and I think everyone is going to be in for a big treat. Scott is a prolific entrepreneur. I've not met anyone who started as many businesses as you. Scott has founded 34 companies and has actually led and run 17 of those. And we're going to get to Scott in just a moment. I want to do the introduction. He's currently the founder and CEO of two companies, Zag and TrueCar. And just for disclosure, GRP, the firm that I'm a partner at, is an investor. I'm not on your board. I'm not the investor, but my firm is a very happy investor. Let me just quickly say a big thank you, and we're going to talk about them later, to our two sponsors. We have PickClick, P-I-C-C-L-I-C-K, PickClick, which is a visual search engine, and we will go through that in a moment, and LegalZoom, and we'll talk about those later in the show. But Scott, let's start with you. 34 companies, how on earth did this all start?
I love the idea of just coming up with solutions to big problems and then starting a company around it. For me, it really was more sort of a default setting, given that I am a multiple-time college dropout and really needed to create my own opportunities.
But you started well before college. Your first company was even pre-high school, was it not?
My first company, I was 14, and it was sort of a Tom Sawyer gig. I lived in a rural area outside of Sacramento, and I just loved driving cars. And so at 14, obviously, you're not allowed to drive cars legally. And the way that I sort of circumvented that was by creating a detailing service that allowed me to drive the car from the person's home to my house. And then I employed all the other kids in the neighborhood. We made just enough money to pay all of them something to be able to do the work, but I was the guy shuttling the cars back and forth.
And was it legal? Were you allowed to drive the cars?
Well, I mean, we were on, sort of back country roads, so I'm sure.
I'll take that as a no. The first car I ever drove was a special edition Trans Am. It was the most valued possession of a friend of mine's father. I also grew up in Sacramento. We talked about this briefly before. And we decided that we were going to take two girls to lunch. And I'd never driven a car before. And this was the thing, he only drove like 2-3 times per month. And we went and we took the car out and he let me drive it. God knows why. I'd never driven a vehicle in my life. And we ended up getting caught, before we ever had the lunch. And anyway, that was my first car driven.
Yeah, my grandmother used to let me drive her car up and down her driveway, and God, I think I was like 8 or 9 years old. I mean, it was just ridiculous that she let me do this, and she had one of these old classic Thunderbirds, and so that was my first car driving experience.
I guess in the driveway you can't do too much, but so you started your first at 14. What would be your first, what I would maybe call serious company that you're not doing just for driving cars?
Well, while I was in school, I started a company called Auto Access, and so there's a theme in most of my businesses that at least half of them are auto-related, and I've had a long-time love affair with a car that started with driving my grandmother's T-Bird up and down her driveway.
Right.
But Auto Access was an electronic database.
But when you say in school, which was it? High school, was it college?
So this is after I had left West Point, and I was at Cal Berkeley, and I was a rugby player and a student at Cal, and completely impatient and wanting to get going on stuff. And so I started a company called Auto Access, which was an electronic database of used cars for sale.
Okay.
And this was in 93, 94. So Netscape and
pre-internet, I guess.
Well, no, post-internet, but
pre-World Wide Web,
pre-Mosaic, and really sort of the graphical web. And so we actually created a 1-800 toll-free service where you would call and you would be able to say, I'm looking for this type of car, and then we were aggregating all of the newspapers and auto traders and scanning all of that information in, and then we would consolidate that and give it to you in a faxed report.
Okay.
I mean, definitely pre-internet, but definitely auto. And
did it require capital to start, or was it some?
It did. So I borrowed $250,000. I didn't know anything about raising money at the time, and that was really my first outside funding event.
How on earth did you just know wealthy people? $250,000 in 1993 for a guy in college is a lot of money.
It is, and I think it all came from my ability to just leverage personal relationships. So at the time, I don't think they were really investing in the business. I think they were investing in backing me.
Right.
And I think it was very important, given my decision to be a career entrepreneur, to make sure that they got repaid. And so when I ended up selling that company, I made sure that every person who invested capital ended up getting probably 3x their returns.
Was it parents of classmates, or?
No, it was people that I had met, just introductions. There's a guy starting a business, and I would go out and I would pitch, and it was really my first experience pitching my own ideas and learning how to speak investor.
And you dropped out of college.
I did.
So that was a pretty good sign that maybe you'd be a great entrepreneur in the vein of Bill Gates and Larry Ellison.
Well, I mean, it's interesting. I think that they had a clear vision about how to change an industry. I certainly had an opportunity to sell a company while I was still a student, and I made a couple $1 million and realized that I could probably do better following that path than staying in school and finishing. And I literally sold that company 2 weeks shy of graduation. So
you're kidding me. So you didn't graduate?
I did not.
Okay. What was your very next business after that?
Well, I had an earnout from the company that ended up buying me, so I had to stay with them for about a year. Got frustrated doing that. I ended up sticking with auto, and I've had a number of auto-related businesses over the years. And for a while, I got into dentistry, and I felt that I've always had a belief that the best businesses solve real problems, and where there's frustration or pain, there's a solution. And so. Obviously, auto and what's going on in automotive, to me, is just a really big opportunity. And I think that what's happening, just in this last week with Tesla really sort of highlights, I think, what a transformation
the industry's going through.
Well, I think that the consumer's changing how they behave. I think dealers are changing how they go to market. I just think that there's so much obvious frustration, intuitional frustration around just buying a car and what that experience sort of represents to most people, that there's a big opportunity there. So,
how important is it in your mind for businesses that people start, for the people to have domain experience? I mean, obviously, it's been a theme for you, and we're going to continue discussing in a moment. You've done many more auto industry stuff, even after those initial ones. Is that absolutely critical, or?
Well, I think if I reflect on sort of my career, I can say that I'm definitely more effective as the CEO of an auto-related company, having had auto-related experience. I can do more today. I have more access. I have more momentum than I've had in the past. And so I wouldn't say that would have changed my opinion of what I should go after. Clearly, you have to have passion and an understanding. And one of the great things about being an entrepreneur is if you start a company from the ground up, you become the world's leading expert on what you do if you are truly a student of it. And you have to be honest with yourself about what it is you're trying to do and what you're trying to accomplish. You don't want to be too idealistic. But I would say that if I look back at my first auto-related venture and whether or not I would have invested in it, I probably would have been making a decision about the entrepreneur and not the size of the opportunity at the outset. Whereas today, I think most of our investors, and hopefully GRP being one of them, looks at the size of the opportunity and what's going on in auto, not just who's running the company.
We like to say that we invest in entrepreneurs, but only in entrepreneurs in which we believe there's a big market opportunity.
Sure.
So, if you're looking around these days in real estate, in mortgages, in auto, in things that are transformative in terms of industry structure, those are the really big opportunities. Eric Paley, who founded Bronte, is a company based, I think, in Boston in the dentistry space, who now is a managing director at a fund called Founder Collective. And he wrote a really interesting blog post that I just read this morning where he was saying, is it Blink or is it Moneyball for investment? And what he means is this. I don't know if you read either of these books, Blink or Moneyball, but the idea behind Blink is that we as individuals have a very quick ability to intuitively suss out other individuals or even market opportunities. So that's kind of one view of the world, the Blink view. It's the gut feel about things. And the Moneyball comes from the book by Michael Lewis about the manager of, I think it's Billy Beane of the Oakland A's, who instead of saying it's about this intuitive idea, it's all stats, it's all numbers, it's all facts, it's all research. And so he found ways for low amounts of money to build a team that was competitive in baseball, not on gut feel, just based on stats. And so there's this kind of debate going on of whether it's intuition or market study. Are you more on the, you really need to study your market, you really need to know where the economics are?
Well, I think it's a bit of both. I mean, for me, I'm a student of auto and I'm a student of our business, and I think that you have to be if you speak investor and to be able to raise capital to fund the business. I do think there has to be an X factor that you assign to the entrepreneur if you're backing a company, and certainly the business that you're in, you have to be able to suss out who's in it for the right reasons and who's likely to win and why. And I do think passion has a lot to do with it, but there is sort of a combination of passion and competency that I think don't always come together. You know, the number of entrepreneurs that you'll meet that have a tremendous amount of passion, but that are completely unrealistic about how to get there and what they need to do. I think that's a real issue, and it's certainly a challenge for any investor.
It's interesting. So I like to say my decision for a seed or A round investment, meaning early stage, is 70% entrepreneur driven. Understanding their character, their motivation, their competence, how effective they are as a leader, how they're going to act in tough times. And that's all judgment. But the 30% is certainly market. And I've taken to telling people you really need to do some level of financial modeling, some level of, I mean, it's never going to turn out exactly how you think. But if you haven't done any preparation for the market that you're addressing, I think that's a really risky proposition. Now, I know that it's become popular to say you don't need to do that in a world where you have Facebook and Google and Twitter and other successes. But for most businesses, I think it's pretty important to do that kind of modeling. Does that comport to your view? Well,
I would say that I would never have been able to raise money if I didn't have the ability to model the business and understand the key drivers. And so I think where many entrepreneurs fall short is a fundamental understanding of their business model. I think the assumption that they're going to aggregate mind share or eyeballs or whatever you want to call it, and that they'll monetize them later, is the luxury that you would only see in a couple of business models. I don't think that that's a good way to go about raising money or starting a business. I think that, in fact, having been at a number of incubators and also having an incubator myself, I can say that one of the disciplines that's critical in starting a business is sitting down and saying, okay, not just what does the P&L look like, not just what is the the statement of cash flow and sort of all of the balance sheet stuff look like, but can you actually show it in a very simple visual model that sort of has your key drivers and the waterfall of how unique visitors or audience turns into revenue? You know,
I've been in the era of Foursquare. I've been talking to a lot of people about retail-driven business. I think when you're 23, 24, 25, and you're thinking about starting a business, everyone seems to want to gravitate towards, I'll create something that serves bars and restaurants, right? Because that's the world you know. So, I mean, just the most simple thing that I often talk about with entrepreneurs who want to do bar and restaurants, which is, okay, at least you should know what is the average sale of a local retail company, not a national chain, but a local retail company. What's the average sale? What's the average profit margin? What's the average amount they spend on marketing, and in which categories do they spend in marketing? What does it cost to actually reach a customer? Are you going to reach them via telesales? Are you going to reach them via direct sales? And for me, it's not that you have to know exactly how your market's going to break or your product's going to break, but if you don't understand the basics of that and you're launching a product in that market, I think there's no chance you'll be successful.
I think that's right. I mean, I think there's also a sort of a phenomenon around the proliferation of apps and how the web can truly aggregate that kind of activity in a way that's efficient. I mean, it would be impossible, for example, to have sort of a pub crawl, couponing business, because you'd have to go out and get all the restaurants to individually sign up. But to the extent you can have an app that gets millions of users right up front, and then that gives you the draw of the right restaurants or participants on the other side of the equation without having to go out and build an organization to sell them.
Listen,
it scales.
Totally agree with that. And so the conversation normally goes something like this. Are you going to aggregate audience, or are you going to aggregate retailers? Like which of those, because you need to get one. Ultimately, I think you need the audience to get the retailers excited. So that's why Foursquare, Gowalla, Booyah, and a number of these have been quite successful. For people who are trying to create marketing solutions for retailers where they're selling to retailers, I think understanding the retail economics matter. I want to come to your next business in just one moment, but I want to use this opportunity to thank PickClick. PickClick is one of our sponsors. It's PickClick, pickclick.com. It is a visual search engine that works on eBay, it works on Etsy, it works on dating sites, and it also works on recipes. Obviously, this weekend in the US is July 4th, so one of the things you could search on, for example, is Independence Day. And it'll show you a bunch of dishes. Here, we're scrolling through some of those dishes. And it gives you a visual way of finding things you're interested in. So let's pick one of those. Patriotic pasta. If you click on patriotic pasta, then that's going to drill down into the recipe itself. So this tool works really well for things that lend themselves well to visual search. And I think going and finding a bunch of data oftentimes is much harder than seeing a kind of visual dashboard. Something I know as we talk about TrueCar, perhaps you can elaborate on, but thank you to PickClick, and we'll come to our other sponsor in a moment. Tell me the first big VC-backed business you did.
Cars Direct, I think, is probably the big example for me. That I think was a transformative experience.
And what year did you raise money? What was your first dollar into Cars Direct?
Well, I was an Idea Lab CEO, and so Idea Lab actually did the seed round.
And just for anyone who doesn't know, Idea Lab is an incubator based in Pasadena in Los Angeles, started by Bill Gross. Some of the companies that came out of there, besides, I guess, Cars Direct, would be Overture being, I guess, the best known. eToys was also another group.
Best known for a while.
Best known for a while. But certainly a lot of innovation came out of there. eSolar is a more recent one. X1, there's a number of them. So they started a bunch of companies. You were one of the CEOs of those companies?
Well, I was. And I think that Bill gets a lot of credit for being, I think, in many ways, the formative catalyst for e-commerce and the whole revolution around e-commerce. And Idea Lab was a great place to be. I mean, we were willing to do intrepid things there, like go into a highly regulated industry like car retailing, and just completely kludge a solution that was to cut through everything. Cars Direct had a very simple premise that we were going to sell cars directly, which to anybody who's bought a car is appealing. The idea of not having to go through a dealer or a middleman is a very, very appealing concept, and people could immediately understand that idea.
Were you going to buy the cars in real time, like as you got an order, then it went back, so you didn't have the inventory risk? Or?
Well, I think that there's a whole bunch of idealism that goes into the exercise. I can tell you that the regulatory issues are probably the biggest hurdle, right? The franchise law that protects the existing 38,000 franchisees in the auto distribution network on the new car side have a lot of protections, and manufacturers cannot sell directly.
Right.
With the exception of manufacturers that have no franchisees. So Tesla would be a great example of a manufacturer that can sell and control their product and control their brand as a result.
Right. So the first round at Cars Direct, was it provided all by Idea Lab, or?
No.
Okay.
No. So Idea Lab gave some seed capital. We then did an A round, and that was done in I think it closed in February of '99.
Okay. And pretty frothy market.
Yeah, I would say it was a pretty exciting time. And Foundation Capital led that round. We had Prime Media Ventures. Idea Lab participated in the round. It was, I believe, $7.5 million at 12 pre. We ended up doing another round that was led by Michael Dell and Goldman Sachs, and that was, I believe, in March of that same year. So literally like a couple months
later.
Yeah, 2 months later, I think.
Okay.
And I had seen Michael Dell on Charlie Rose, and he was asked if he wasn't in the business of selling computers on the internet, what would he be doing? I think he said, I would, he thought about it, actually. It was a very interesting interview. I remember where he paused and he's like, I guess I'd sell Furbies and cars. and Charlie Rose's answer was, well, eToys is already doing the Furbies thing, where are the cars? And so I literally reached out to all of our board members. Michael was a limited partner at Idea Lab Capital.
Okay.
And so we ended up getting on the phone, and I ended up going down to Austin and meeting with Michael. He led a $22 million round. Okay. And that was done, like I said, just a couple months later. And I think that was done at almost $60 million in valuation.
And I mean, you didn't obviously need the capital at that moment. Was that a mistake to raise that much money that quickly? At least we can talk later about the larger round, but that $22 million round?
I think there's a very natural balance between demand and sort of the need for capital. I think the idea was a big enough idea to be sure. It was also a transformative idea. I mean, it really could change the way people buy cars. And so if you're going to do it right, raising the appropriate amount of capital is important. And so, yeah, the times were definitely frothy. There were lots of willingness on the part of investors to invest in an auto-related play.
If you're in a frothy market and you're an entrepreneur, should you raise the most amount of capital that you can at a highest price you can?
There's lots of good arguments, yes and no. I mean, it depends on really coming to grips with you as an entrepreneur. What are your personal goals with the company? How fast do you want to build it? How big is the market? And what do you need the capital to do? I think in the case of the businesses that I've built, for the most part, I'm not as interested in businesses that are just about how many widgets do we sell and can we monetize and for how long. I'm very interested in, does this solve a fundamental problem and lead a transformation in the marketplace? Can we be the dominant player in this space? And so Cars Direct at the time, I think, was facing two challenges that it needed to raise money for. One is the potential downdraft of the bubble bursting, and I think there was enough forecasting around that possibility at the time where raising enough capital was definitely a goal, and being able to survive that. I think the second thing was that Cars Direct, if you really look at the potential to disrupt that channel, you actually have to sort of vertically integrate. You should buy car dealerships and actually begin to sell those cars truly directly. And so it was a very capital intensive play depending on how aggressively you wanted to.
Because of the regulatory issues, you actually had to own the car dealerships to sell the cars directly.
If you wanted to go all the way to the extent of selling them truly direct.
Right, and would you have to own a dealership in each state then?
Each state, each brand. So you've got 40 brands, 50 states, you do the math, right?
A lot of dealerships to own.
Yeah.
Now, you went on to...
But far more efficient than 40,000 dealerships.
Sure,
right?
sure. You went on to raise a mega round. When was that?
Well, that was the...
Or was it all done over a series of deals?
So it was a total of 3 outside rounds of capital. So the third outside round was nearly $300 million, done really sort of, I think, at the peak of the market.
Was it in early 2000?
It was late 99.
Okay.
So it was in the fall of 99.
And who led that?
Oh gosh, Idealab.
Who were some
actually
of the,
Idealab?
Who were some of the big participants in that?
So we had all the major investment banks. We had a lot of notable investors like Larry Ellison and Michael Dell and Hikari Tushin, Flip Filipowski, George Soros. Yeah. I mean, I think everybody was sort of picking us as the company that was going to transform that space, and it was a big enough space where it could accommodate that. But we definitely sucked, I think, the venture capital out of the market following that round.
And the company ultimately, if I'm not mistaken, went public.
It did. So it's public today under the name Internet Brands. And really, given the shift in e-commerce, I think that the strategy that the CEO at the time and the CEO still to this day, Bob Briscoe, took, which was really to focus on advertising and lead generation as its primary source of revenue, was wise. It preserved the capital and it got the company very profitable.
Did the company ever buy any dealerships, or it abandoned that model before?
I think when I left the business, the strategy shifted. We were well on our way to buying dealerships.
When did you leave?
I left in 2000. Middle of 2000.
Circumstances of your leaving?
So I had never taken a company public before. I had always been a startup entrepreneur, and I think in much, I think it was rational at the time to say, I could bring somebody in and I could partner with them. I think the goals for the business fundamentally changed. I'm a builder. I definitely am about recruiting people, recruiting money, and really focusing on that vision. I'm able to speak investor, able to raise money, but I had not yet at that time proven that I could run a business, let alone run a business profitably. So having a partner to do that was really, I think, very important.
Did you stay on the board for the IPO?
No, I didn't. So I was on the board really for about a year after I gave up the CEO job.
And when did they IPO?
IPO 2006.
Okay, so many years later. Yeah. Okay. What did you do immediately after that?
So from there, I've had a number of other businesses. I really do believe that auto is going through a major transformation. So I started a company called Build to Order. Okay. And Build to Order was really focused on recognizing that not only was distribution screwed up in auto, but manufacturing was also screwed up. Right. The system of building cars to inventory to then push them out to your distribution channel means that you always have a mismatch between really what you have in the inventory system on the supply side and then what consumer demand actually is. So cars ultimately have to get discounted.
I guess that would be an idea that, well, maybe by now Michael Dell was pissed off, but it's an idea that would have been more after Michael Dell's heart, right?
Well, I think that's ultimately why Michael Dell initially invested in Cars Direct. Okay. The concept that, if Cars Direct could truly disintermediate that channel, then the ability to actually own brands and manufacture cars, and I think most brands today have really evolved to a design brand statement as opposed to what is their true manufacturing efficiency or capability. I think most car makers don't value their manufacturing capability as their core to the value.
What was the name of that company?
Build to Order, BTO.
Build to Order. And was somebody, so because you would sell cars that didn't have existing dealerships, you could have sold direct? Was that the idea?
It would be company-owned stores. So again, very similar to what Tesla is doing today, where they control their own distribution, they own their own stores. I think the premise was we'd have to build our own brand, design our own vehicles, and create a following for that. So there's a whole bunch of inherent challenges that we never got to that point. We ended up raising enough money to really get the first part built, and then we decided that it wasn't a business that we were able to pursue just because of the amount of capital required, and I think that times had fundamentally changed. Raising money in 2003 was not a lot of fun, no matter who you are.
How many different fundraising activities have you been through? How many different road shows or events do you think you've been through all your companies?
So actually, I got asked this the other day. I think we've had 58 closings.
Oh, unbelievable.
Yeah.
For which you were involved in
Yes.
leading the fundraising activity.
Yeah.
Have you ever used an outside company to help?
I used one once as an assist to raise some debt, and I would never do it again. But all the equity capital I've raised.
I have my own views as an investor, which I'll tell you in a moment, but how do you view that topic? Because obviously some people do rely upon private placement firms, which are called investment banks, which do a process called private placement. Is it an industry that shouldn't exist? Why do you not like it?
Well, I think it depends on the entrepreneur, and it really depends on who the backers are and what they bring to the table. I think that there's certainly a Silicon Valley model where the power of some of these firms, from a venture point of view, is so strong that they can complement a weak entrepreneur who's just focused on a vision, and they can say, look, we're going to bring in all of the horsepower behind you to really go out and pursue that. I think in reality, though, a big part of what should sort of vet a company in its early stages is whether or not that company is fundable.
Yeah.
And it is an important thing for the entrepreneur to be able to raise money. And so much of the vote on whether or not a company should exist or shouldn't exist is really on whether that CEO can do that job.
At the stage I'm involved, again, seed round, A round, I tell people this all the time. The reason I don't like to be approached by investment banks or private placement firms, part of what I'm judging in the individual is how did they approach me? How did they get access? How did they follow up? The whole process of raising funds tells you something about the entrepreneur. So the idea that an investment bank is going to do this great investment deck and spreadsheets and put this nice patina on it kind of destroys some of the discovery process for me. Not to mention the fact that they want to take 7% on the back end of any money I give.
Yeah, I'm not a fan of people who aren't committed to the process. I put a really big value on passion and sort of the IQ that goes into the idea. The number of ideas that I hear about that have no sort of intellectual quotient really sort of bother me. I mean, I'm just not interested in those businesses. I think they can make short-term money and they might be able to be profitable for some period of time. But I think that the businesses where you have somebody who's very passionate about transforming a market and solving a real problem, those are very interesting. I think that I wouldn't personally back an entrepreneur who wasn't able to raise money, though.
Right. So, I mean, it becomes the defining, or one of the defining metrics for whether or not they should be backed is how they act during the process, and are they able to lead that fundraising process?
Sure, they need to be able to articulate their vision, and they need to be able to speak investor. One of the things that we do that I think is really key is we're able to translate everything that we talk about into absolute metrics and say, you know what, these are the key drivers in the business. We know that unique visitors convert at the website based on the value proposition, the site design, the site flow, all of that into,
How can people learn how to speak investor? How did you learn how to speak investor other than just going through the process? Or how could one learn these days?
Well, I mean, for me, it's just been a numbers game. So no matter how much I've raised or how many closings I've had, I've still had to go out and pitch every time a large volume of folks in order to get to the folks who end up investing. And I don't think it matters who you are. I think you have to find the right fit. I think one of the things I've learned is I'm very now selective about who I approach in the first place. Because I just don't want to waste my time or their time.
Right.
Knowing who's likely to invest, how much and why, and how that's going to come together, I think matters.
Are there tools out there that you think people can use to find out that information?
Yeah, you can do a lot of research about sort of the kind of financings that are happening. I think it starts with a bit of realism. I think most entrepreneurs are unrealistic in general about how much of their company they're going to have to give up when they take venture capital. I have a sort of a theory that it doesn't matter how much money you're raising, you're always going to give up a third of the company in every round.
Right.
It doesn't matter if it's a $1 million round or a $100,000 round or a $10 million or a $100 million round.
So that informs a view that says you should, within reason, raise slightly more money rather than slightly less in your mind?
Personally, I believe that's true. And I'm actually running two companies now that I'm very focused on making sure that they are in a position to operate well. I'm not as worried about financing anymore. And I don't, quite frankly, financing is a distraction at this stage in our life cycle. And we're now fully capitalized, so we can turn all of our attention to the strategic and business development and sort of operating initiatives.
How much cash, in your experience, when you fundraise, do investors want to see you have in the bank? Is it 9 months, 12 months, 15 months, 18 months? Is there not a number in your mind?
I think every deal is different. I mean, it really depends on sort of their confidence in the entrepreneur's ability to go out and get more money. I know that most of my investors are confident in my ability to get money, so I could probably make an argument for a shorter sort of leash on how much money we need at the current time. And obviously taking money at a lower valuation and taking less of it is obviously better. And I think it all comes down to the deal. Right. Again, if you were going into a financing hoping to sell much less of the company, I think the investors would say, no, take a little bit more, right, or they would try to hammer you on valuation. And so knowing that going in and how that all works, I think is very much to the entrepreneur's advantage.
So I want to talk about Zag and TrueCar. I want to, though, first talk about our other sponsor. Our second sponsor is LegalZoom. Have you used LegalZoom product? Are you familiar with LegalZoom?
I am. In fact, LegalZoom was getting started when we were launching Cars Direct, and so I know some of the founders.
Oh, you do?
Yeah.
So I've talked about it openly on the show. I actually have used LegalZoom in my personal life on several occasions. I find it's a phenomenal site to get a lot of legal documents that are prefabricated. You can go in, use the documents, oftentimes don't need legal advice on a lot of garden variety issues. It's not a law firm. It's a firm where you can go and get the documents and get some support in getting those filled out, but it's not a law firm. And they actually have done a special code for viewers of This Week in Venture Capital. If you type in TWI, when you go to LegalZoom's website, you'll actually get a discount on their services. If you haven't used LegalZoom before, I would encourage everybody to check it out. And thank you, LegalZoom, for sponsoring the show. Tell us about Zag. When did you come up with the idea for Zag? How derivative of it was Zag, because it's in the auto sector of your former company, Cars Direct?
Well, I think it's all part of the same effort. What's interesting is finally what's going on in auto is creating an opportunity to transform how cars are sold. And I think what we're focused on at Zag and at TrueCar, now that they're really combined as a single entity, is really reinventing how cars are sold. And it's not just for consumers, it's also for the benefit of dealers. I mean, the business of selling cars is fundamentally changing, and dealers have all sorts of margin erosion, and they have challenges about how they're going to compete with the other 38,000 dealers that are out there. And so I think recognizing that the consumer is shopping differently than they ever have, that the car is a commodity, and that if you and I are both going to go and buy the same car on the same day at the same dealership, there shouldn't be a different price. But
what is the variance in price? I mean, I've read studies in the past, for example, that minorities pay significantly higher for cars than other people. Is that true?
So there's no question that disadvantaged buyers, and it's not just minorities, it is also the credit criminal. It's, right, the elderly. I mean, there's all sorts of examples of a disadvantaged buyer.
Segments of people who perhaps have not researched pricing enough.
Well, I think objectively speaking, disadvantaged buyers pay more across the board. But what's really fascinating is...
Do women pay more than men? I mean, I don't want to get in trouble, but is there any data?
They do. And actually, that's not...
My wife always makes me come in and do the negotiating.
That doesn't mean that all women pay more than all men.
There's many things I'm not good at, but she definitely brings me in to do the negotiating.
So one of the things that's fascinating, and we actually measure this at TrueCar, is what other people paid for their car.
Okay.
And so I can tell you that, for example, in Los Angeles, last month, and there are about 200 Ford stores in Southern California, and they all sell the same F-150 and the same Ford Fiesta, and the same
200
product.
Ford dealerships just in Southern California.
That's correct.
That's madness.
It is madness. So you've got just a massive overpopulation of dealers, which creates lots of choice for the consumer. But what's fascinating is the price distribution for the same car, apples to apples, 30 to 35%.
Wow.
So if you think about it, we're talking on a $50,000 product, a $15,000 difference. I mean, that is a massive problem. And so really, you can almost correlate that to brand dissatisfaction as well. The person who's paying over that price is definitely going to be dissatisfied when they learn that they've overpaid.
Now, the manufacturer has a pre-agreed price that they sell to the dealer, if I'm not mistaken. So you'll tell me if I'm wrong. I don't know the industry like you do. So it's really, the manufacturer doesn't necessarily care about that price, but the dealer themselves get more profit or less profit based on how much they're selling the car for. Wouldn't they be against what you're doing? And was I right about manufacturers? Not
to some degree. I mean, there are definite dealers who have a lower cost base than other dealers based on either volume or quality. And so there are lots of ways that dealers can make money that don't really surface to the consumer. And in fact, the industry about 15 years ago shifted to not just publishing what they call MSRP, but also publishing invoice.
Right.
What's interesting is when they published invoice, most people thought, oh, well, they're publishing cost.
That's what they paid, yeah.
And depending on the manufacturer, there's between 5 and 13 hidden layers of profit that you don't even know about.
Right.
And
so one key message for anyone who's interested in cars and autos is invoice does not equal the price that dealer paid.
That's correct. Invoice does not equal cost.
Right.
It's an English word, but only in automotive invoice does not mean cost. And so we use a term called dead cost or true dealer cost.
Okay.
And it's important to understand that if you're a negotiator who likes to go sort of from the bottom up and make sure that the person you're negotiating against gets a fair deal.
Yeah.
If you could go in with any kind of a vendor and say, well, what's your cost, and I'll give you a fair margin.
Yeah.
That's one way to negotiate. The other way to negotiate is to understand where the market is. And it's fascinating when you start to look at the actual distribution of what others paid. You get real context about what is a fair deal.
Can you just show us a quick example on TrueCar? I'd love to just show that graph.
So we're right at TrueCar. So we're looking up a Nissan Altima in Santa Monica. And you can come in, configure the car exactly the way you want to buy it. So we actually add all of the options and accessories that you're looking to configure on your car. And then we analyze the data based on now looking at almost half of all transactions across the country. And what you get on really this initial page is the Gaussian curve.
Okay.
And to your point earlier, dealer cost, we now show. So you don't.
How do you know that dealer cost? I mean, that's something that's hidden. How are you getting at that data?
So it really just comes down to expertise in the business. I mean, you have to understand how the different manufacturers are analyzing dealer costs.
Is that based on estimate, or is that based on real data coming from real purchases?
So it's real data, but it's not down to the individual dealer. So if you were buying a Toyota from Longo Toyota, which is one of the largest in the country, they might have a lower cost base. And actually, the key to dealership profitability is recognizing there's 4 major costs in selling a car. It's commissions, it's the SG&A to run the dealership, it's the marketing expense on a per car basis, and the depreciation of that car while it sits on the lot.
Right.
Each of those, roughly hypergeneralization, work out to about $500 per bucket. So you've got about $2,000 on the hood of every car.
Right.
If you're a modern dealer and you aren't finding a way to take $2,000 in cost down to about $750 in cost, then you're just not going to be competitive, because you'll sell a car for, say, $20,000. You'll lose $1,000 when your competition can sell that same car for $19,000 and make $250.
Gotcha.
Right? So the way that TrueCar works is not only do we present the Gaussian curve, but we also present the same data in the form of a bar chart. You can come in and look at it locally, regionally, or nationally, which is helpful depending on whether your market's competitive or not.
Are dealers now familiar with this? I mean, could I print that out, march it into a dealer, and say, this is what I'm paying, do you want my business?
This is factual information. So if you are shopping and the dealer does not want to play ball, get up and leave the dealership, because this is where the market is at. And for example, if you're looking at the Nissan Altima here, this is here in LA. This is the actual histogram distribution. So you can come in and you can see actual purchases over the last 30 days on a rolling look back of what people actually paid for the car. You can also look at it nationally and regionally. And obviously, as you get to a larger sample size, it begins to look more of a normalized distribution. Then one of the things that we're also doing is, because we have the business with ZAG, where we run the auto buying programs for a lot of these major brands like USAA, American Express, Consumer Reports, we actually have a network of 3,700 dealers around the country that give us upfront pricing on their cars. And so what we've done is we've contrasted their upfront pricing against this curve.
Okay.
And price confidence has become really the new focus for the online shopper.
So TrueCar, as a consumer, is price discovery, but not purchasing. ZAG is a place I can actually buy a car online and have a guaranteed price, or at least know it's somewhere within the Gaussian curve that is favorable to me?
So for the consumer, TrueCar really is the front end.
Okay.
So you can go to TrueCar. Not only can you learn through price discovery what others are paying, what the dealer's cost is, and what is a fair deal, but you can also now discover those prices. And we use the Zag engine to be able to provide that experience.
Why would dealers let you do this?
So dealers want to sell more cars. I mean, it's point blank that simple. And we don't believe that a free market results in an unsustainable outcome. We think supply and demand actually do equilibrate. And so the real problem, and I think when most people hear about TrueCar, they say, well, gosh, dealers must hate this.
Yeah.
And the reality is, if the market is already behaving a certain way, then the dealer is willing to sell the car, or most dealers are willing to sell the car for that price already.
Right.
So when a customer comes in and they're informed, and they've got the information and they understand what is a fair deal, they're more likely to buy the car, they're more likely to be happy, and everybody wins. And so this is not about an unsustainable outcome. This is about preventing the customer from getting taken advantage of, or the dealer's business model being premised on having that bell ringer one-off sale that just completely clobbers the customer.
So I just want to take a user comment that they're putting. It says, the one thing about TrueCar that's not cool is how they get their data. I signed up for Zag when I worked for a dealer, and I did not know that they would use that data when they got it from us at the time for this purpose.
So it's not being driven by Zag data. So today, almost half the market is reporting into TrueCar, and a transaction actually surfaces about 6 or 7 times.
So if I understand, just to be sure I understand, so you have dealers. The dealers provide some pricing into Zag, which is never disclosed at a dealer level. Separate to that, you have TrueCar that has pricing discovery, of which half of the data that they get for that analysis has nothing to do with Zag.
Has nothing to do with Zag. So Zag is really an auto buying program operator. We run the affinity auto buying programs for USAA, AAA, Consumer Reports, American Express, a total of 44 brands.
Yeah.
And we white label that product. And if you, and actually I can show you here. If you were a USAA member, this would be really the experience that you would get when you come into the USAA homepage for car buying. And you'd be able to select a new car, and we'll go do the same exact search we just did, right? So you come in, select a Nissan. We'll pick the Altima.
And it just looks like I'm buying it from USAA, but it's really driven by your engine.
That's correct. And the way that Zag works is Zag does not spend any front-end marketing dollars. We white label this product, USAA offers it to their members, and then the dealers who are on the program get the benefit of these customers coming in expecting a USAA experience, and they get incremental sales. What's different about TrueCar is that TrueCar is simply out there gathering data from banks, credit unions, information providers, registration providers.
Yeah.
I mean, a transaction shows up almost as many as 10 times in the overall ecosystem. Even if you apply for a car loan on a new car, that shows up. So we are now buying data from so many sources that has nothing to do with Zag. So that dealer's concern is intuitive because we run both businesses, but it's just not factual.
He later wrote a comment that I read on the board here that said he really likes the product. He just wished it was disclosed up front that some of that data may be used. I want to talk a bit about, and I want to pivot off the companies for a moment, but I want to just ask you, how big is Zag now in terms of sales?
Well, and I think this goes to the issue of how do you raise money. So one of the things we do at Zag is we actually track all of our performance, and this goes to the dashboard concept and how I run the company. What I've pulled up is our dashboard. It shows how many unique visitors.
This is internal for Zag. This is a management tool that you use inside your company and also make it available to investors.
That's correct. Okay. And what it does is it transparently reports really our top of funnel conversion rate, prospects, close rate, sales, and revenue over the last 30 days. And then I can come in and I can drill down and look at individual partnerships, for example. So I can just say, you know, how is our USAA relationship working? And I can slice all of the data that way. I can analyze demand through heat maps, trend analysis, prospects to sales, revenue, and I can look at that historically and then based on our business plan going forward. And then this is really a very important part of understanding our business. This is a flash widget that really shows exactly how the business works, and you can see that I'm driving up revenue on the far right, and
what is it you're clicking on, just for people
the
watching?
Number of unique visitors on the front end.
So you know the metrics in your business say, if I can get more users to land at a fixed conversion rate, how will it how will it affect revenue? If I could get more users at a higher conversion rate, how would it affect revenue and profit? And therefore, you can play around with programs that say, how do I drive more people to my website? Once the people are there, how do I get more conversion? And then you build in all of these key drivers that show you the outputs.
Well, not only has this become an incredibly important management tool for predicting how the business operates, but it's also very good at letting everybody in the company fully understand their contribution. So if I'm working on web design, I can come in here and I can say, you know what, if I affect conversion rate on the website negatively, how will that affect our revenue stream? Okay. It also happens to be the one great way to explain to a potential investor exactly how the business works, rather than handing over a complicated financial model and having your champion at a venture firm try to make sense of it and then walk into all of his partners.
Because, you know, when we take the spreadsheet, I can tell you what we do is we go in and we change assumptions. So you'll say my unique visitors are going to go from 700,000 to 1.2 million to 2.4, whatever, at a certain growth rate, and we're going to convert at 3 to 5% or whatever, and they have a scale, and we just go in and make our own assumptions. So you're just giving us a tool to do that better.
Exactly, and what we have found is that it hypersimplifies for the champion at the venture firm to be able to explain to their partners exactly how this business operates. And so this is a very visual tool. You can walk in and say,
but
you know what,
this is not a package I can buy. You built this, right?
No, we built this.
Okay.
We built this, and actually, what's interesting
is that your next venture? Is that spitting this out?
No, because I don't think it necessarily transforms anything. I think this becomes a tool on a
could be like a little widget tool set that enables people to build this. I know, having seen this I don't know, 2 years ago or so, every company I've invested in, I've asked them to get in touch with you to figure out how they can build their own. At Ring Revenue, a company I invested in Santa Barbara, has now implemented their own version. It's awesome because, you know, I probably don't log in enough, but you can log in remotely. I can see how many calls they're doing per day, how many of them are commission active, how many they're converting on. It's awesome.
Total transparency, nowhere to hide, and it now gives me the ability to manage much more effectively. Right. Rather than having meetings after meeting after meeting, I can literally look in, I can go right to the dashboard, I can see exactly which metrics aren't performing and know exactly who's responsible for that. And then what's even better is when you look at how the dashboard sort of reacts to new opportunities, you can come in and analyze business development and strategic opportunities immediately by saying, okay, let's stress test what this relationship will do to our conversion rate. It'll drive volume, but conversions will be lower. It's not a profitable idea. Let's not build that.
And
out.
if I paid attention, I think on your first dashboard you logged in, it was something like 10,262 cars sold last month, something on that order of magnitude. How big is that? I mean, how many cars are sold in the country per month? Where would that put you in size of dealerships?
At this point,
if you were a dealer.
Yeah, if we were a dealer, it'd put us somewhere in the fourth or fifth largest dealer group in the country. And what's interesting is AutoNation, which is the largest, has about 1.6% market share. So there is no Microsoft or sort of dominant partner or distribution channel in auto. I think our goal, which is more interesting based on this system, which is very scalable, is that our economics, we want to get to about $1,000 per customer, which rivals the dealership's economics on a new car sale. The average car dealer is making about $700 in front-end gross on the sale of a new car, believe it or not. We want to get to better economics in a car dealership in that regard, but we believe we can get to at least 10% of the new car market. So that would be 100,000 sales a month through this system. And there's no reason why it can't scale to that. I mean, we've got today 3,700 dealers. We believe that there's probably a saturation point at about 4,000 dealers where we don't really need any more. And I think it really is about that pipeline.
What's going to happen in the country, in the United States? Is regulation going to change such that a lot of these dealerships are going to go away? Are they protected? You know, the fact that we as taxpayers have funded to prop up car companies, is that having any impact on things?
Sure. I think what's happened in the last 18 months in automotive is really remarkable. I don't think anybody would have really forecasted it. And we lost about a third of demand in the marketplace. And it was a combination of things. It wasn't just the economy. It also happened to be a shift in consumer preference for what we drive in terms of miles per gallon. And the product lineup that most of the American car companies had was really sort of light in that area, meaning we didn't have enough low or high mile per gallon cars to really sell. And so I think what's going to likely happen is that the laws of the free market are going to prevail, and you're going to see a lot of dealers sort of have to go out of business because there's just not enough oxygen in the room for them, and that's a good thing. I think that the dealers that survive will go to market differently. I think the new car will behave much more like a commodity. I think the new car salesman will go the way of the travel agent, and it's an amazing thing, having been in this business now for almost 20 years, to see it finally happening. I mean, it's been the thing that I've been focused on, and sort of the epic win. The ability to reinvent how cars are sold is now possible in a way that never has been before.
And someone is writing on the message board that, just to clarify, you don't actually sell cars, you're not actually a dealer?
We're not. So we work with the dealers, but what we do, which is remarkable and different than lead generation or any of these other advertising channels for the dealer, is that we force them to give us an upfront price on the car, and then
you only get paid when they sell the car, right? Or you mostly get paid?
We get paid when a car gets sold. So in the classic sense, we're a performance-based marketing company.
Yeah.
We charge the dealer $300 when they sell a car, and we dynamically generate that invoice when the car gets sold, and we can prove it.
What lessons have you learned through, I think you said it was 58 individual funding rounds. What lessons have you learned that you can impart on people about raising capital?
That's a really broad topic. I would say probably the most important thing is decide whether or not you want to stay with the company for the long term. Mm-hmm. I would say if you do want to stay with the company for the long term, be careful about how much you raise mm-hmm. and how much you control of the board and who you partner with, because those are truly your partners through that sort of growth curve of the company. I think probably the most important thing that I can say at this point in my career is that you only want to take money from people who you want to work with.
Right.
You are picking your business partners, and it's not just money.
I always say it's more difficult than marriage, because in marriage in the United States you can get divorced. You take money from a VC, it's tough to get divorced, in that company anyway.
Having just been through a divorce and
knowing you and Elon Musk, right?
I would actually say that divorce is worse by far.
We won't go there. Any specific tips for how to increase your probability of raising capital for all the people struggling through rounds right now?
Well, first, get realistic. Make sure that you're targeting who's likely to invest and why. Get educated about what a seed round looks like in the current market, what an A round looks like in the current market. I mean, you can't go out for a $20 million A round if $20 million A rounds aren't getting done.
Right.
And there's great examples of anomalies. I mean, Mahalo raising money at a crazy valuation, it's sort of bucking that trend.
Jason said it was crazy low, he said.
That's exactly why he was able to get it done. But I think that those are the outliers. I think in general, you have to recognize you're going to sell 30% of your company. You have to conform to sort of where the market's at the given time. And I think today it's not 99. You're not able to do the same size of round, and you need to sort of be educated as to where the market's at.
Okay. I want to do a very quick rundown of deals. Probably don't have time to discuss them in depth, but I want to make sure we cover for people who are interested. Finally, Foursquare announced that they closed a round, led by Andreesen Horowitz, reported at a $95 million valuation. I think it was raising, $20 million with participation from Union Square Ventures and O'Reilly AlphaTech Ventures. I saw a tweet from Bryce from O'Reilly AlphaTech that said the wire transfer heard round the world. And they were rumored to be in discussions with both Yahoo and Facebook about selling the company. Obviously feel they have a much bigger opportunity. I mean, is that a crazy price in your mind? Is Foursquare like transforming an industry?
I don't know enough about Foursquare. I think it's a clever product. It certainly is fun. I think that when deals get active, and they really trade on potential. I mean, the capital markets are very good about rewarding the potential for a company, and we just got through a round, of relatively that size at approximately double that valuation. So I don't know that it's crazy.
Gotcha. They double that valuation.
Almost double.
Just heard that at the last minute as I was looking at the next deal.
You invested.
Yeah, we did. I did know the price, but I just wanted to make it clear. Kontagent, I don't know if I'm pronouncing that right. It's a social analytics platform for Facebook developers. We've actually talked about this deal before. $4 million by Altos and Maverick Capital. I don't want to focus on that. We've covered this one before. Geodelic is another deal that was done this week. Geodelic, we've also talked about it, was funded by Clearstone and Shasta Ventures up north. They just announced a round, MK Capital participating, $7 million round. It's a sort of new UI for mobile devices to help you better discover information. It doesn't compete with Foursquare and Gowalla and everybody else. It's really a visual metaphor for finding stuff, although I'm told that they, over time, likely will go into check-ins and other things. Will be a crowded space, but very, very good CEO who I quite like, Rahul.
And great venture backers.
Great venture backers, yes. I'd say it's interesting. I had this discussion with someone else. Someone was really surprised. I said, wow, $7 million. I don't know the details, so I'm specifically avoiding disclosing anything because I don't know. But I would just say sometimes 7 million does not equal 7 million does not equal 7 million, meaning it's possible that 3 million was a bridge round that was done a year ago by investors, never converted. 4 million of new capital came in. And I'm not saying that about Geodelic because I don't know, but I just want people to know in general when you read about rounds, it's not always as straightforward as the number that's published.
Well, but I think that's by design. I think at this stage in a company's life, they're focused on casting the biggest shadow and creating the most momentum and creating the most dominant position they can in their market. And so they're gonna
announce the biggest number they can.
That's right. And we do that all the time.
I'm going to skip a deal. I'm going to go ahead and do a deal called Vopium, Vopium. It's a Danish VoIP, voice over internet protocol company, founded in 2006 by an entrepreneur named Tanveer Sharif. They've raised new capital for international expansion to compete and challenge Skype. It says the current round is $16.5 million, which is a pretty big whopping round. Skype seems to be like the dominant player in VoIP. Do you think there's room in the market for someone new?
I don't know enough about the market, but it would seem to me that it would be hard to go up against Skype.
Skype's just established like
with a
brand
Skype follower.
And this consciousness. Do you ever use VoIP? Do you use Skype ever?
I do.
Okay. Yeah. For me, Skype just showed the cleverness of Andreesen Horowitz because they were one of the leading investors who led the spin out from eBay. And Skype just has so much potential, both in terms of transforming the telecom sector. You talk about transformative industry. I remember 15 years ago reading articles in The Economist about what they called the death of distance. And the death of distance was saying, well, in the past, you paid a fixed fee based on how far away you are because the circuitry was such that their cost was related to how many hops across how many different telco devices you had to go. Now it's just irrelevant. I mean, their real cost structure is how many packets are going on a databases, and voice takes such little in terms of transport. And I think they really have innovated in this market, Skype has. And what interested me is that they've now announced a product that competes with GoToMeeting and competes with WebEx. And for me, I see so many Skype users and so many loyal users, and the ability to move from I've got you on video and now let me show my screen is just phenomenal. I think so much potential in Skype.
Well, and I'm very curious to see how even things like the new iPhone and sort of the two-way video chat capability get embraced. I think that you're going to see a much bigger adoption of video for lots of uses as that becomes more seamless.
Even when you saw, like on this MacBook Pro here, when you saw integrated webcams, I think it drove a lot of adoption because I started using Skype in 2005. I lived in Europe, and we would communicate with my parents in the States and want to show our kids. And you had to go out and buy this little webcam, and I had to buy one for my parents, and I had to help them figure out how to install it and get it set up. Now it's all just integrated, and as you're saying, now that it's in the mobile device, I think it's going to drive more and more usage.
I think that's going to explode it, but I also think it's a generational thing. I think if I just look at my kids, that they are using things technology-wise that we would have to figure out, and it would read the instruction manual. They get it when it comes right out of the box. And I think that there's a whole generation of users that's using Skype today that just wouldn't even think of it as an issue. I mean,
how old are your kids?
8-year-old and a 3-year-old.
8 and 3. So very similar to me. I have 7 and 4. We just bought them iPads, or I bought my wife an iPad and my kids one to play with. Just shocking to see my 4-year-old navigate his way around. I mean, intuitive.
Completely.
First of all, children these days are phenomenal, but the intuitive design that we take for granted, that out of the box a 4-year-old can come and figure out how to navigate this. It's just phenomenal achievement on Apple's.
Not only navigate it, but to have your 4-year-old come and be able to say,
Daddy,
what's your password? Yeah. Like, just so that they can log on to your iTunes account so they can begin to buy something. I mean, that they found the App Store and that they know how to navigate the App Store.
My son was using our Mac, and my wife came home and she saw that there was stuff in the trash can, and she goes, oh, what's this? And turns out he didn't quite understand the concept of not dragging and dropping things to the trash can. Another deal that was done this week that really, I think, surprised a lot of people is called Palantir. And I think it surprised people because a lot of people hadn't heard of it. I read the TechCrunch announcement when it came out, and they were talking about the number of times they reported on Facebook and the number of times they reported on Palantir. And I think Palantir had one article, yet they just raised $90 million from the Founders Fund, Ulu Ventures, Glen Capital, I think it is, and some others. And what this is doing is, as I understand it, it's helping people visualize large data sets, and in particular was being used by governments for intelligence gathering and so on and so forth, but hedge funds are using it, the intelligence community, so on and so forth. I mean, this is a big idea.
I'm a massive fan of the visualization of quantitative information. Tufty, I'm a student. I mean, absolutely a big fan of it.
Gotcha. And I am working on a project that we haven't yet announced that does exactly this, is trying to take data sets and provide better visualization for companies to make bigger decisions.
We, in fact, you know, it's interesting. We are always playing with the algorithm around which dealers and which markets and which brands. And obviously that's a complicated issue. We used to manage that with spreadsheets and looking at the data. Now we have demand heat maps, which says where are our customers coming from. We can filter that by brand, and then we can overlay the dealer network and then say which are our dealers. Immediately you can analyze which dealers we should.
You don't use your own heat map technology. I presume you use kind of off-the-shelf.
We're buying all of that technology, but we're integrating it into a stitched-together sort of way of analyzing it, where anybody in the company, you don't have to be an analyst, you don't have to be good at the reading the matrix. You can really go in and understand visually exactly the right decision to make, and it's a really big assist in terms of how we make decisions.
Another deal that was done this week is one that I'm disappointed that I wasn't involved with. It's called Triggit. Triggit, Triggit. They play in an area called DSP. It's a DSP, demand side platform. And as advertising, banner advertising is moving more towards people purchasing it as a more commoditized product, and you can combine buying banner ads with behavioral data to help you better buy stuff. The demand side platforms are helping advertisers making these purchase decisions directly. I've looked at 2 of them. I didn't end up doing either of them. One of them I was excluded because I was an evil VC and they didn't want to take VC money. This one, I talked to Zach, but I had talked to him too late. The deal had already, the train had already left the station. But in a recent one we've talked about, it's called Invite Media. I think the founder was 23-24, sold to Google for $75 million. So there's a lot of interest in this area of quantitatively looking at buying advertising and getting away from the clubby 26 to 28-year-old purchasing it through cocktails at bars and stuff.
I think it's true across the board. Computational analytics. There's a great book by Ian Ayers called Super Crunchers, which is absolutely talking to this issue.
And so you'd recommend it to people?
Absolutely.
Super Crunchers, Ian Ayers. And the last deal I just want to mention, and then we'll wrap up the show, is called Getjar. And what Getjar does is it allows you to, it's an app store. It's a store for buying mobile applications. It's the second largest, only to iPhone store directly, to the App Store, the Apple App Store. They just raised $11 million by Axel. I think his name is Rich Wong, if I'm not mistaken, the guy who did the investment. Axel's probably got the hottest touch in Silicon Valley right now. It's the firm that everyone that I know is anyway talking about. So they've invested in this firm. I believe they were originally based out of Europe. They have 70,000 apps for all major mobile OS platforms, including Apple's. And it's a place that people can go. And presumably it's interesting to both app developers who want to distribute. And you know, the problem with distributing on iPhone is it's hard to know how to develop an app that actually gets eyeballs, that gets You know, there's the lack of transparency on how to drive stuff that drives downloads on the iPhone. Hopefully that'll change over time. But it's been fascinating talking to you, Scott. I really appreciate your time. Lots of interesting advice out there from someone who's fundraised quite a few times. And certainly we're all betting that the auto industry is going to go through this transformation. I think most consumers would also love to see it as well. So it's just a car salesman who won't want to see it. And a big thank you to both LegalZoom and to PickClick, our two sponsors. There's one spot open. If you're interested in that spot, please email mo@thisweekend.com. Thank you.
Great. Thanks for having me.